Hey, welcome everyone. Thank you for joining this afternoon's webinar. For those of you on the East Coast, everyone else in the other time zones, good morning. My name is Ted Steinkamp, and I am the speaker, or I shouldn't say the speaker, but the presenter of today's webinar. And I wanted to bring you through a few things here about Advanta IRA before I bring on the speaker. But just a quick background about me. I have been in this business for over 35 years now. Started back in 1989, and I can tell you it continually changes. And now that Congress has passed a new tax package, we will probably have some more changes and maybe a webinar on that in the future. But I've been here with Advanta IRA for just literally a few days over 1 year, so my 1 year service anniversary. Contact information below if you wish to contact me with any follow-up questions. Don't worry, I am going to post this slide again toward the end of the webinar. But as we start to dig into this, let me just do the quick compliance disclaimer. When you're in this business for 36 years, compliance is everything. So just want to make it very clear that Advanta IRA and its employees do not endorse any particular investment or investment provider. We're providing this as an educational service so you can learn more about different types of investments that are out there, because trust me, the creativity and just the sheer number of options out there, it's amazing. But as with all investments, do your own due diligence. Speak with the proper advisors that you need to, whether it be your attorney, accountant, financial advisor, etc., before making a decision. I have found during my 36 years of doing this, best decisions are well thought through, and I'm sure the guest speaker, Ivan Alfaro, will agree with me on that. A couple of quick things about Advanta IRA. We have been around and in the business for over 20 years. We have a very deep bench of talent here at the company. Number of our colleagues are CFPs, MBAs, attorneys with legal backgrounds, and of course, most of our associates here have the Certified IRA Services Professional designation. As far as the size of the company, we have over $3 billion in assets under administration, and we did get our mid-year numbers for 6/30. We've had 20% growth in that, so we're now up to 3.6. So we've had a really strong start to 2025. Everything is very solid and secure here. Obviously, the investments are in your account, but any cash balances that are uninvested, we hold that cash over in FDIC insured financial institutions, and of course, the applicable FDIC insurance limits apply. We also like to keep business personal here at Advanta IRA. In the modern age, it's very easy to get distance from your customers and your clients. We don't want that. That's why every client and every customer has a dedicated account manager, and they provide concierge style service. Basically, you can pick up the phone and speak with a real person. They have a name, they know you, you know them. It's none of the leave a voicemail in the, call the 800 number, leave a voicemail, wait a few days for a phone call. We have established service standards that all of our account managers must meet, and they do meet them. Now, just real quick, if you're new to self-directed IRAs, just kind of want to review what the concept is, because frequently the word self-directed gets misconstrued and misused. What we mean by self-directed IRA, or self-direction over here at Advanta IRA, this is a slightly different and it's slightly unique account format where you can go out and select investments that typically are not going to be found at a brokerage firm. And I'd be very confident in saying 99% of the time, you're not going to find them there, because only about 4% of IRA accounts are truly self-directed, where you can go out and purchase anything with the exception of life insurance contracts and collectibles. But anything else you can do. So you're not limited to mutual funds, ETFs, stocks, bonds, and the like. Now, when you take a look at really what are the advantages of self-direction, well, for one, it gives you complete control over your retirement funds and those respective investing decisions. And it also gives you a very unique and different way to invest from the standpoint you can invest in things in what you know and what you understand, as opposed to what someone has on their investment menu or whatever institutions they have existing sales agreements with. I also have up here on the slide just really what are the more common things you see, such as real estate, mortgage notes, private placements, cryptocurrency, syndications, etc. But I can tell you the list and the creativity is endless. We see people invest in music rights and royalties, washer and dryer units for rent, cemetery plots, livestock. It's mind-blowing what can be done. And the good thing is we can record keep it. So we are the source for that. Now, why would you really want to pursue self-directed investing? Well, for one, a lot of people don't understand that their IRAs are a new source or a usable source for investment capital. A lot of people think when those IRAs get established, they just only use what they can buy at a brokerage firm. Not the case. Stock market fatigue is a big thing that we hear from a lot of our existing client base. They're just not happy with the ups and downs. Fortunately, things have been up since April, but hey, like all things, law of averages takes over. We will experience some pullback in the market one day, just don't know when it'll happen. But if you're looking for perhaps above average returns, maybe self-direction is something for you. And of course, the tax benefits of being able to use your IRA to invest, it's phenomenal. If you use a Roth IRA, obviously you hit the 5-year seasoning rule. Everything in there is tax-free upon distribution. And for those of you that use traditional IRAs, you get to defer the taxes and the gains on the investment activity that occurs inside that account. Only difference is there's going to be taxes due upon distribution in the future. But we can also do a little bit of advising and helping you understand the difference between the two, conversions, etc. We're here to help and happy to have that conversation with you. As far as the accounts that can be self-directed, if you just look at the slide, basically anything with the letters IRA after it. And then, of course, healthcare savings accounts and education savings accounts can be self-directed. A lot of people are not aware. And for those of you that are self-employed, by all means, take a look at the solo 401k. We have a very robust plan document here at Advanta IRA, and you can literally have the best of both worlds. If you want to do marketable securities, self-directed alternative investments, you pair a business owner with a self-directed 401k and an accountant that also understands that, you got a pretty powerful combination and can actually stash a lot of cash away for your future. We're all about ease of doing business here at Advanta IRA. It's very simple. You can go to the online portal, open an account, takes 15 minutes, documents you can sign digitally. When it comes to funding your account, if you're transferring money from an existing IRA, we will execute the transfer process on your behalf. Once we have completed documents, we do the heavy lifting there. And if you're doing a rollover from a former employer's retirement plan, we'll certainly walk you through the steps because there's a few things you will need to get involved in, but we'll certainly coach you, provide guidance, and help wherever we can to make that a smooth and easy process. And of course, the final step is really up to you. Go out and find that investment. Let us know what it is. We'll help get everything in order so you can hold it inside of your IRA. And as far as the resources that we provide our clients, and really anyone who is not a client, of course, on the events tab on our website, you'll find the webinar listing and the upcoming schedule. So feel free to go out there, take a look. We do have those. One of my colleagues, Alex, he does a podcast series. We will have some very similar speakers talking about some different subject matter. Some of it's similar, but it's a different format. Sometimes it's more agreeable than a webinar for some folks and some guest speakers. And then, of course, the blog. We can Occasionally, we will have some material out there that we will blog about, as will our clients. So really, as we take things in, what I want to do is introduce to everyone the guest speaker for today, Ivan Alfaro with Common Walk. And Ivan, you want to start taking it over from here?
Yeah, I'd be glad to, brother. And please reach out to Ted just to kind of call that out. He's the first guy that really spoke to the IRA process in a way that's simple to understand. Everybody else is just gobbledygook to me. So definitely use that resource, guys. He's really agreeable and just fun to work with. If we could go to that next slide, we could go over some of the company highlights. Thank you, Ted. So in terms of Common Walk, and then we'll get into introducing me. We currently operate about 25 doors. At our highest, it was 93 doors. As some of you may know, acquiring and exiting assets is just a regular part of the business. We can consistently provide robust returns to our investors while also giving a hand up, not a handout, to communities in need. We've invested over 1.2 million of our own capital. We've operated, like mentioned, 93 doors, maintained 12% plus ROI to investors over the last 10 years, sold 78 properties. That's through our Common Walk Realty arm too. So we do help people buy and sell. So that's kind of a high level of the company. There's some of our staff there on the right and some of the event pictures too. If we could go to the next slide, I could jump into my introduction. And this is kind of strange, right? It's let me tell you about how awesome I am. It's kind of a strange thing to be doing it, but you know, I am a little bit humble, but I'll go ahead and describe some of the things we've done. Probably the most beautiful thing we've done out of all of these pictures is we went on a mission trip to Puerto Rico, and some at-risk youth were at an orphanage, and I got to speak to them about investing. And for them to see a fellow Latino that really made it was something special and meaningful. They were shy towards the beginning, of course, as kids will be, but towards the end, as you could see there, they started smiling and asking questions. And it's always amazing how the youth ask so much pointed questions because they want to, you know, grow up to do great things. Some of the other pictures there where you see me with a microphone, I did a Buckhead real estate investment mixer about 2 years ago. We did about 5 of my peers, expert investors, that basically came and just did a speech for me, for the audience too. That was a great favor. And we had like 100 attendees there. It was an awesome, great time every single time. Probably the biggest brand name recognition thing I've done there is CBS News towards the center, speaking on attainable housing. I've also written a book, spoken for DeKalb County on how churches could get involved in this key work, spoken on panels and all sorts of networking events. I'd love to get to know more of you, and we could talk about how you could get my contact towards the end. If you could move to the next slide, please, Ted. You know, what this is really about, oh, actually, that was correct, yeah, thanks, Ted. What this is really about is family. So let's talk about the first things first. This problem is building up families at the end of the day. If you fix that problem, all of our societal issues, which we'll cover 17 of them that this investment attacks, but this is what it's all about. There you can see my family. I'm half Peruvian, half Dominican heritage. And, you know, we didn't have that perfect of a time like any family growing up, but we still maintained unity. And so what this investment is really about is me transforming my childhood pain that could affect so many lives and transforming it into gain. Let me give you a quick little story here. Imagine that you had a neighbor of yours that would involve a single mom, and there was a child there, and he was just a little itty bitty 10-year-old child. And as you kept in touch with them over the years, you noticed, oh man, that single mom, she has to move every 6 to 12 months because just the realities of real estate, it keeps on growing. And so she has to move further and further away from the city. Her job becomes further away, more bus, train fare. less time with the kid, and therefore less unity, less relationship, less friendship. The kid himself has to change schools also every 6 to 12 months and make new friends. So transience is just a part of their life. They can't maintain a close relationship. Why even have a girlfriend if we're just going to move again? Why invest in self if all these things are just going to continue happening? So it builds a barricade against development, really, of the soul. And so you as a neighbor, want to ask you, what would you do? Would you figure out a way to get involved? Perhaps investing in some attainable housing, perhaps even just mentoring, showing some financial literacy, perhaps doing a few things? Or would you just kind of shrug it off and say, I got other things to do? And if you were that guy, which I'm sure you're not, or gal, you would be denying 10-year-old little boy Ivan. And how heartbreaking would that be? Little boy Ivan. It's a story that I grew up with, and luckily I had mentors to break me through the mold. And even some people that financially invested in me, sometimes even not even that directly. Like I won a computer from a radio station one day. And so that was a life-changing thing for me to move on to greater things, becoming a website developer, etc. And that eventually got me into investing in real estate. And a short story version of how I am who I am today, a syndicator. So all it takes is really one courageous person to invest, and things could change for an amazing, amazing life. And an amazing society too, because now we're helping dozens of people every day. But yeah, now we can move on to the next slide. Thank you, Ted. Here's the index of what we're going to cover today. What is this attainable housing investment? Like in terms of what are the assets and the strategies at a high level? Why invest in it? And then we'll go into some nitty-gritty details, case study 1 and 2. Case study 1 is going to be kind of a smooth sailing type investment. Number 2 is going to be quite an adventure, and how even that we broke through, and it's going to be an amazing testimony. So let's go ahead and jump into the next slide. Thank you, Ted. The types of assets we target are between 2 to 40 apartments at a time. The intention behind that is because the due diligence is much lower and cost of due diligence is much lower than 100 or 200 units. And because we care for our investors as we're growing, we do not want to be spending due diligence money on something that may not even close. So when it's a duplex, for example, or even a 30 unit, we could spend a couple thousand to just make sure it's the right property. In some cases, if I walk through it, I could assess it rather quickly. But if you're talking about 100, 200 units at a time, you're easily going to spend $20,000 to $40,000 on due diligence on something that may not even cash flow at the end of the day. You may not even close on it. We invest in specific markets that have area and economic drivers that we research well over time, and we'll get into more details on that later. We also have requirements for specific conditions, like it has to be majority occupied, no major issues like foundation or roof or mold issues at scale. And so some of those are the requirements. We also don't depend on the government. Although there is a useful part to Section 8 and the housing authorities, what we've noticed is that they can be quite slow to basically make it happen, to get tenants in there, to get us as a landlord approved, and we'll also get into more details on that later. All right, Ted, if we could please go to the next slide. Thank you. But first, let's address that elephant in the room. Could you imagine if this just walked into your office? It would be quite awkward. But seriously, what the misconception I get the most are these four here about this type of investment asset, attainable housing. Number one, hey, Ivan, you just have a bleeding heart, man. You aren't making any money on this. Come on. And the reality is this is highly profitable. We're going to get into the numbers of this, but I'll give you just one of our case studies. We purchased a 12 unit for $540,000. Today, 3.5 years later, it's worth $1.1 million. We've doubled the cash flow from $70,000 a year to about $140,000 a year. So based on that 15 seconds alone, this is not a bleeding heart operation, and it would not be sustainable if it was. Another misconception I get is, Ivan, you don't have any expectations of your tenants or any of the other people involved. You're just handing out money, and that's just patently false. There's something that I despise the most in life is entitlement. And one tenant a few months ago said, oh, there was an accounting issue with the rent payment and I owe you $10. And he said, you'll be fine. You don't need it. And I lost it. Out of the 3 times a year I lose it in a professional setting, it had to be an entitlement. And I said, you don't understand. Even 1 cent matters. It's not just about the money, it's about the meaning behind it. If you feel entitled to 1 cent or even $10, then you can't manage much higher than that. And besides that, there are investor distributions at play. Everything has to be accounted for to the T. Number 3, headache clients. So another thing is I hear, oh, over in this attainable housing, you must have late payments all the time. You must have the vacancies over 50%. You must have people just stepping on you all the time. And they're actually under 10% vacancies. That's what we've seen over 10 years plus. And it really comes down to management experience to make that happen. Screening, unlike my first year in this business, when I had a 1-page lease, I was just signing up for trouble and I didn't really screen people. So I made my way through that and learned the hard way, have a rock solid 15-page lease that covers every single possibility. It's so serious that we say, hey, tenant, if you call us more than X times a month, especially about simple things you could do yourself, like a light bulb, your rent has a 3% increase next renewal. Like, we take this stuff seriously. Unprofitable is the last part. So I already kind of spoke to that with my brief example. It is highly profitable, but it also requires higher experience. Not the average beginner could jump into this without education. And now we're ready for the next slide. Thank you, Ted. So let's look at other stats of why you should be involved in this. The shortage of affordable and attainable housing costs the US economy about $2 trillion annually. So if you're a part of that equation, imagine how much money that you have or stand to make. Of course, no investment is guaranteed. I'm not going to paint a picture of a crystal ball to you, but it's an absolute need. And we have statistics around it. We could move to the next slide, sir. Another thing to think or to consider for this is that other types of businesses are already at scale investing in these sorts of areas that have attainable housing. Grocery stores, even other developers. You hear all the time, even outside of my for-profit, nonprofit developers that are involved in 100, 200 unit developments. For us as for-profit, we find it a lot more faster, and there's an intention behind that. A nonprofit board, let's say they find an asset like the $540,000 one. Well, they have to wait till the next quarterly meeting with their board to decide to acquire that asset. Meanwhile, if it's a great deal, somebody else is going to nab it quickly. Versus a for-profit, we can move fast at speed to the profit, right? Other investment businesses, banks, other high margin business, thrift stores, laundromats, or passive business, barbershops, nail salons, and restaurants. We see restaurants consistently of a certain grade investing in these areas. And they're doing it because it's profitable. Otherwise, why would they bother? And consistently bother. So that misconception of, oh, these are unprofitable, crime-ridden, war zones. Now, let me be real, however, there are some war zones that you should avoid. Those are D class, and that's not especially for the beginner. That's why we go after B and C class, right? So keep that in mind too. You have to do your due diligence, hang around the areas, drive the areas you're considering. If you're going to be an active operator, drive the areas for several nights, see what it looks like at night. You want to take your investment very seriously. And yeah, we're ready for the next slide, Ted. These are actually risky propositions. Cities with no corporate headquarters, no major franchises, no transit, no affordable workforce, no airport, and no developments. So as much as I hate to pinpoint a specific city, one thing that many people ask me about is, what about Macon, Ivan? You could buy a property there for 5 to 10,000. And the reason for that is all of these items right here, they do not pass them. Now, if you go further along to Columbus, Georgia, that has a military base. There's numerous franchises there. There's all sorts of things going for it. So we feel more comfortable with a outskirts city like that, or maybe on the outskirts of Metro Atlanta versus something like Macon. You can't make bacon in Macon. I'm sorry. I had to include a corny little rhyme there. Other things to avoid that are risky are landlord hostile states. So California is obviously one of them. There are some states that you may perceive to be landlord hostile, like Wisconsin, but if you go to Milwaukee, for example, they're actually doing evictions in like 30 to 60 days, just like here in Georgia. Another thing to avoid is obnoxious judges, dated laws, or dated systems, excessive litigation, judicial statehood. So when it comes to a non-judicial state, which is basically a lender could foreclose on the property without any notice or consent, in some cases even taking power of attorney to move forward without any notice whatsoever. Although that sounds really gangster, it actually helps to provide more capital to that state, and lenders become a lot more faster to provide debt capital. So these are all things to consider when you're investing in specific states and cities. We can move on to the next slide, Ted. Thank you. These are also other things I want to mention in terms of government dependency. So just to draw through this real quick, I'm probably going to cut through half of this slide because we're kind of running short on time here. Is the voucher program. Although it sounds nice, you could get your money on the first. It's great, but what they don't talk about is that let's talk about Atlanta Housing Authority, for example. It'll take 3 to 4 weeks for you as a landlord to get approved. You have to get an inspection done. If they give you a checklist, you have to work through that checklist. And I'll give you a literal example. I purchased a duplex for $107,000 just 5 minutes south of downtown in like 2018. And it was pretty much move-in ready. There was some cosmetic stuff. We painted, handled the most critical items. And in one of the units, the furnace was just shot. It was really not literally shot. It was just rusty and basically dilapidated. There was no point to just replacing it. We just put 2 big old window units, one in the living room, one in the bedroom. But when Atlanta Housing Authority came, they said, hey, by the way, since you have this furnace here, you have to replace it for $5,000 or whatever. I'm just estimating the cost. And I was like, why? And they said, because we have a rule that if a furnace is already in place, even if it's broken, you have to replace the entire thing. And I said, I'm not gonna move forward with some arbitrary rule and spend $5,000 unnecessarily and destroy my profits for several months when I could just rent this on the market for $1,000 a month. And people would be glad to get that. That's naturally affordable, no government dependence. And so these are things to consider when looking at government-based programs. In terms of the government financing, kind of the more federal side, one thing to consider is that LIHTC requires a little bit of a high overhead. You have to have somebody that's certified to make sure every dollar is accounted for. So for you to have those tax savings, you have to really have it down to a T. And you probably have to have like $5 million in the bank, to be honest, because you're gonna apply for projects that the state also has to approve. So, that's another risk too, that you may have a project within a 1 mile vicinity for 100 units, and the state just decides, actually, that developer half a mile down the road, we like his project better, so we're giving him the tax credits. And so you spent all this $100,000 on due diligence, making sure you could grade the property, the plumbing, the drainage, the sewer systems. So that's why I say you got to have millions at a minimum to do that sort of stuff. So that's something to consider too, that it's not just, hey, I want to sign up for LightTech and we're done. All right, we can move on to the next slide. Thank you, Ted. So why invest in it? So there's constant demand for attainable and affordable housing, whereas there's lower demand for luxury apartments when, I'm not even going to say when, I'm going to say right now, because they have just 15% vacancy rates and constantly increasing in this day and age right now. We started seeing this downturn in late last year because of oversupply. So luxury apartments aren't always needed, whereas attainable housing properties are. And also to address fix and flip properties, you're looking at minimum investments of $250,000 to $300,000 to buy a house right now, with the intention of flipping it. Well, you better have that ARV to be in the $500,000, $600,000 range, and you better, if you have to do additions on that, you better make sure that county does not draw you out for approvals, for all the process of the bureaucracy, because that's just all things to consider. And meanwhile, you have a hard money note that you have to pay every month. It's probably a lower risk to have capital investors if you want to get into that flipping business right now. Although that's still risky too, because if you don't sell that property in short order, all that money is just tied up. All right, we're ready for the next slide. Thank you, Ted. Here's another statistic that's interesting. 100 affordable housing units creates $12 million in local income, plus 160 jobs in year one. So one thing to consider too is that get your education up if you're not familiar with this business. I heard a heartbreaking story when I attended a local Atlanta RIA. He bought 2 single-family homes next to each other, and he was not well versed in what to look out for in a property. And unfortunately, it turned out it had foundation issues. So every time he would apply for Atlanta housing, every year to get that voucher program, he thought he fixed some part of it, but it ended up having another issue. So this guy was just bleeding money left and right for years and years, and it's just heartbreaking. And that's just the lack of education and the lack of also a network that cares about you. Whenever you get wholesalers sending you deals, you got to vet it. You got to get inspections. You got to educate yourself on what to look out for and all these things to consider. There's numerous other voucher programs, in some cases that are even more profitable, and that's just something to research later. We just focus on the tried and true, simple, straight to the point, naturally affordable and naturally attainable, which is we buy a property around the 2% rule and we just keep it moving. All right, we're ready for the next slide, Ted. Thank you. Another thing to consider is that billionaires are already doing it. Warren Buffett, Richard Lefrak in New York, Stephen M. Ross are just a few of the billionaires that have invested millions into this. And so you may want to just research what they do too. They are in different aspects of the game. All right, we could go to the next slide, please. Thank you, Ted. So here's my favorite slide, okay, because I love being a hammer. I love speed, I love action, I love fulfillment, and all of these things come together in this slide. Attainable housing increases healthcare access, tax revenues, so improve infrastructure, workforce, disposable income. That's probably the #1 thing for the economy, right? Disposable income. You're going to want to spend money locally if you actually have, rent not drowning you. It boosts the local economy because of that. You get more essential workers coming into town, and it just makes the community more stable. Of course, you got affordable rents, attainable rents. You're building your life up. I can't tell you how many people that have been our tenants that within 2 years they were able to buy a house. One of my favorite tenants was a guy that basically reunited with his family. He had a tough background, so he made some mistakes in life, but within 2 years of staying at one of our places at just $800 a month, it was a smaller unit, he was able to rebuild his life, reunite with his family, and they all reunited and bought a family house in Conyers, Georgia. So that's the special stuff that I see every day, and it just keeps me coming back for more. However, lack of attainable housing affects the number one issue that really translates to all the problems in our society, which is marriage unity and family unity. If you can't have a stable income, your marriage is probably going to go down. You're also going to be pulling your hair and probably, acting out in the home, which is not going to make the kids feel safe. And so I experienced that firsthand. I had a divorce. My parents divorced when I was 5. And so there's consequences to that, and there's repercussions that go into society because of that. Whereas if you have more of a stable home, you have reduced crime, you have homelessness. Actually, before I just skip through crime here, did you know if a father is absent from the household, like mine was, I only saw him like every other weekend, that child has a 80% chance of going into some sort of crime in the future. So again, it just speaks to the hammer that this problem solves, or that this solution solves. So homelessness is also reduced, health issues reduced, chronic disease, food insecurity, education mindset. If you're in college or in your child in school, you're not going to have a mindset for education. If you're going through stress, a more positive youth behavior, higher education. So all these things get just quashed and improved with a big old hammer that is attainable housing investment. We're ready for the next slide. So here's an interesting statistic. Of course, as with any investment, past performance is not a guarantee of future results. That said, multifamily was the one to recover the fastest coming out of the 2008 crash. So just an interesting thing. It kind of naturally just makes sense because people need a place to stay versus needing a warehouse or retail first, right? That's mainly for business owners. So there's something to consider here. We're ready for the next slide, Ted. Thank you. All right, let's get into the nitty gritty here. So case study number 1, we purchased it as a 12 unit, and how did it become a 14 unit? Well, the simple way to explain that is we had a 1-bedroom that had 2 entrances on either side. So we just put a wall in between it, and we made it 2 studios. And so we did that twice, and that's how we got to 14. We spent about $300 in capital expenditures, and thereby we increased the rents, which were like average, like really low, like average $625 a month across all units. Now it's about $850 average across all units, and that'll continue increasing, which will thereby increase the value consistently. So as of this year, we're at 1.1 valuation. We have we did have some hurdles, but actually before I even get into that, I didn't even touch on the table here. So this is the trajectory of the income. Because we acquired it in 2022, of course, that number is really low because there was only like 2 months left of rent collections. However, we did still continue and renovated units, so we still faced appreciation there. We did a conversion of that 1-bedroom, the first one, to 2 studios, and that took that unit alone, which was originally renting at $700 a month. Now it's making $750 a side. Okay, so now we got $1,500 a month coming in from essentially what was before a 1-bedroom. And so that continued appreciating. We continued renovating over the years. Last year we had 113,000 rents collected. Last year we got an appraised value of 930,000, and so we continued doing renovations, and so we're estimating, because of the incremental rent increases, that we're at 1.1 right now. We actually have a appraisal that we have scheduled for later this week to confirm that based on local comps. And the hurdles that we faced, we're going to go into more of that in the next slide. But we ended up adding more construction phases, more than we anticipated. And that's just because me and my lead contractor manager, construction manager, you know, as we were opening up walls and seeing this patchwork that previous owners did, we were like, man, let's just make this thing last 500 years. Even if it costs more money, let's just go ahead and knock it out so it could last longer. And so that was the result of that. All right, we're ready for the next slide. Some light surprises, but still kind of things that are lessons learned. We had a sewer drain section that developed a belly, and that was in the parking lot area. So we had to dig up some asphalt and dig up a bunch of dirt about 10 feet down. And that cost several thousand. So that was a not so great surprise. The inspector also did not catch any small plumbing leaks that we ended up finding out about when we had some vacancies. And, you know, we were doing some cleaning and turning over of units. So that was really annoying. So just vet your inspectors if you're going to get somebody that somebody else recommends. This particular gentleman just seemed to be busy with life. He was certified, but I don't think he was licensed. So just to take ownership on that, I took a little bit of the fault. I should have walked through the property with him entirely. I ended up just doing a few units and then going to another appointment. So just a lesson learned there. Luckily, it was really small leaks, so it didn't cause any serious issues. We also unnecessarily replaced some roofs. So 2 out of the 3 buildings, we said, hey, these are graying out. Some parts are even going white from losing their protection layer on the shingles. So let's just go ahead and replace those. That cost like $10,000 total. So we ended up regretting that decision because nobody was complaining about roof leaks. And so we really should have just handled it when it was time, as opposed to being proactive in that sort of situation. We also had some 30% turnover after closing, and this is not that big of a surprise. I would say this because when you have owners that are kind of acting like slumlords, just to be frank, then you're going to have tenants that act accordingly. You know, if you treat somebody like garbage, they're going to treat your property like garbage. So we had people that were late on rent, people that didn't clean their property, their apartments. And so we just had to eliminate those people because they had no intention of changing. They've just embedded that in their character, and we have a higher standard that we expect. So that's just going to be expected. I would estimate 20 to 40% for assets like this. And that's totally fine because that produces the ability to renovate, touch up those units, and charge even more rent. All right, we could move on to the next slide, Ted. Thank you. All right, so let's get to the scary deal. Ooh. So we purchased this in 2015. We've gotten valuation from 150 to 399,000. Rents from 1,050 a month to just the main house to creating essentially extra units on the back side, and that got us close to 4,000 a month. And so this at a baseline doesn't sound scary at all, but we haven't gotten to the meat of it, right? But I'm going to give you some time to look over the numbers there on the right. Pretty good cash flows for a home. And how we did it, how we got units on the back is because the basement was unfinished. And we decided, let's go ahead and finish this thing and charge $800 a month for it. At this rate, or at this year, we could probably charge more, but we're just going to keep it because sometimes stable tenants is more meaningful than going up $100 or $50. You know, we haven't gone up on this particular gentleman in like 2 years, but he's been a great tenant, never complains about anything, and always pays ahead of time. The carriage house, if you squint your eyes and look at the right side of that picture, there's actually a barn looking property there. So that's actually what used to be a woodworking shed that the previous owner made. And so we just converted that to a 2-level carriage house, and that's rented for $950 a month. Also, again, probably next year we could go to like $1,200 a month based on the area, but this is all naturally affordable. And so let's jump into what happened in late last year. Move on to the next slide. Yes, indeed, the garage went up in flames. And this happened because a tenant's guest threw a cigarette in the trash and did not realize that there were sparklers towards some part of the trash can. And so I got a call at 2 a.m. in the morning, and eventually I kind of shook myself up, like, why is this person calling me numerous times? And I went over there, and yeah, it was heartbreaking to see. We had to get some temporary housing adjustments done, but let's jump into the details of what happened next. So the only good thing that came out of this is that the utilities, main living areas like the kitchen, living room, the bedrooms were largely unaffected. It was mainly that garage. So we had to rebuild that entirely. Nevertheless, it was still a big old headache. And, you know, I could get into all sorts of different things that happened. The insurance took a long time. We had a $10,000 deductible because this was a commercial insurance, rental property insurance. That kept our costs down. But, you know, in situations like this, which happened only once in my 18-year career as investing in rental properties, perhaps that may be a reconsideration in the future. But having a high deductible, as you know, helps to keep profits juicier. But there's a cost to that potentially at a surprise like this. We also had to deal with bureaucracy from the government, the specificity around how to handle the permitting process, the title work involved. In some cases, well, in this particular county case, because it's assigned to a business, the LLC essentially, the government was causing an issue saying, oh, you can't do this work with your team because it's not in your individual name. And I said, that's the most obnoxious thing I've ever heard in my life. But nevertheless, we had to temporarily do a quitclaim deed into my name to address construction. Insurance had to be involved in that process too. It took a while for all those just bureaucratic items that were annoying. We also had to deal with a neighbor that was a Karen. And, you know, Karens come in different genders, different colors. And, you know, this was just annoying because one of the most obnoxious things I heard from them during this process was, hey, I have to deal with this view every day. And I'm like, what? Are you ridiculous? I have to deal with the calamity every day. So you got to deal with that too and not lose your mind at people like that. And that's going to happen in investing sometimes. We had to unfortunately miss 2 distributions. Oh, I didn't mention one thing. The carriage house and basement were not affected, so we were able to continue to rent those units. However, it was a break-even scenario. So that $800, $950 a month, you know, that just paid for the mortgage and a little bit extra. So that's why we had to miss those 2 distributions, unfortunately. Luckily, we did not have to do a capital call, which means that we had to call our investors assigned to this deal and say, hey, pony up some extra cash because we have this surprise we got to deal with. So we as the sponsor ate all of those interim costs until we get it finished up, basically. And we're ready for the next slide now. So the silver lining on this deal is that, ironically, after construction is complete, which should be done in the next 1 to 2 months, it's going to make close to $6,000 a month. So almost $2,000. Well, actually, pretty much exactly $2,000 more than what it made before. And that's because we're going to convert the main house to a pad split. And if you're not familiar with that term, it's basically you rent the rooms out. So we're going to have a lot more diversified cash flow in this asset. If we just rented out the main house by itself to a single family, sure, it may be a little bit more stable and, you know, we could help one family out, but there are also individuals that need attainable housing too. And so we could get a little bit higher rents and even convert the garage to a room too. And that actually could be an even higher profit margin for the investors assigned to this through the fund. and through the company involved. We're also going to have newer fixtures. Renovation, of course, is going to cause that. So the valuation of the assets would go a lot higher too. So these are things that, I try to focus on, because it's easy to go into the negative and be pessimistic around, this tenant, why weren't they more careful? But I would say the higher plane of existence of thinking about things like this is, I don't know, I'm going to get a little comic booky here right now, but the Batman trilogy talks about why do we fall, son? If you saw the first movie of the trilogy, that's what the father asks his son, and the son, of course, instilled in his memory says, so that we could learn how to get ourselves back up. And so it's really key to focus on that when something goes wrong, as opposed to just drowning in the pessimism. All right, we're ready for the next slide. Thank you, Ted. So here are some other lessons learned. Pad for surprises like this. So we already have an existing reserve, but having even more would help with this sort of situation. Pause construction even if it hurts. And this isn't just about this deal. Pausing construction, I would say, is about every deal. There's this Bible verse that comes to mind that talks about how, and it's in the Old Testament, if you're a person that is constructing, repairing a home, and you run out of money, you may have your neighbor laugh at you. It's kind of a cruel reality, but think about that. Like, sometimes you just have to wait. Sometimes you have to rebuild your nest egg, build your savings up. Don't put your household at risk by drawing all this construction money out just to kind of get it closer to the finish line. You gotta sometimes pace yourself. And as a part of that, don't let your pessimism get the best of you. Take a 5-minute break. There's been several times in my investing career that I've had to just go to my car, lay the seat back, and just put some piano music on, because that's what's going to calm my body down from what's going on. Instead of focusing on the anguish or the sadness, I could focus on asking the right questions at the right time. Like, what decision can I make today to turn things around? What resources are actually at my disposal? Because your brain will try to trick you and say, oh, you're such an idiot. You should have thought of this 1,000 times ahead of time. And so don't let that negative thinking get the best of you. Get the right questions, the effective questions too, to move forward. Then walk out the answer. All right, we're ready for the next slide, Ted. All right, perfect timing. Look at that, Ted. Right at 12:50.
Yep, we're right on mark. And at this point, what I'd like to do is let's open things up to the attendees for Q&A. Please go ahead and tap your questions into the chat box or for the question box, and I'll see them come up on my end. But really, just kind of to get things rolling here, Ivan. I know most of the portfolio or all the portfolio is here in Atlanta, Georgia, but can you share with us a little bit about where or what parts of the country some substantial opportunities may lie for investing in attainable housing?
Yeah, I would say we also own a duplex in Columbus, Georgia. We purchased that for $46,022, and that's making about $1,000 a month now on total both sides. So Columbus is a market that I feel is pretty strong. You may not be able to find that sort of price point anymore, but there's still great deals to be had. I know a duplex that was sold near that particular property recently was about $105,000, I believe. And so that's likely, collecting like $1,400 a month. So that could be a pretty nice cash flow passive. So that's things to consider. It's also conducive to considering that you should look at more outskirt type properties and also increasing your wholesaler network. So doing a lot of networking to get deals coming to you and not necessarily always be the one on the prowl.
Okay. How about like for example, areas like in the Midwest where values are comparatively lower than, say, someplace like the Northeast, but there's
Oh
still maybe a lot of demand. Can you elaborate a little bit about that?
yeah, I've heard of some college towns that are great in Illinois. I haven't looked into those. What I have researched is Milwaukee, Wisconsin. I touched on that earlier. So probably once we raise $1 million next, then we could explore that market further. I had the blessing of meeting a operator that has 30 doors over there, and it was just a great experience, and a reminder of how this sort of business allows for freedom. This guy goes in sweatpants everywhere he goes. He's just totally casual, and you would never think this guy's a millionaire. But he was so generous. I met him at a networking event in Florida, and he was so generous with his time. When I met him, he said, just come to Milwaukee. I'll show you around. I'll show you the areas to invest in and what areas to avoid. And he showed me this area you could buy a duplex for 85,000 and it's going to be stable. And this other area over here, you could buy a quad probably for 50,000, 60. You're going to spend quite a bit to repair it, but you want to avoid that area because it's a little bit higher crime. So having resources like that is invaluable too when you're looking at markets. And you know, you'd be surprised that even though that's a blue city, it's actually friendly to landlords. Mentioned that that's 30 to 60 days out for evictions. Hopefully it's still the same. I met with him about 2 years ago when we went through all those, driving by those areas and had a lunch afterwards. So yeah, things to consider are, you know, getting to know the people, active operators, driving by neighborhoods. And some people also get overwhelmed by the process of repairing. Like, how should I invest in a out of state, out of city property? I don't know anybody there. Well, you could just go hang out at a home improvement store, see a guy that has a measuring tape and looks like he knows what he's doing. And, you know, in a matter of days hanging out in a city, you could find people that could help you. And sure, it may take 2 or 3 different attempts at hiring subcontractors, contractors that you trust and charge you a fair rate, but that's going to make it a whole lot more worth it versus hiring a GC that's going to charge you 300% markup on everything, you know?
Okay, got time for just one more short question here.
Okay.
And the question is, if you were an investor just looking at properties across the country to invest in attainable housing, what would be your top 3 criteria for narrowing down your list, or really just compiling a list of eligible properties?
Okay. There's several things here. I'll try to whittle it down to 3. Number 1, try to get to that 2% rule, which means if you buy a property for 100,000, it should make 2,000 per month. And I know that sounds kind of pie in the sky, but those deals are out there. In some cases, to a ridiculous extent. A student recently said that they found a $25,000 property and they were able to rent it for $800 a month. So they're out there. It's a matter of looking and the research behind it. Another thing I would look out for is no major mold issues. That could be easy, high risk for especially a beginner. If it's bigger than, let's say, $2 bills stacked together, or even a $1 bill, and you see black mold on a wall, then that may be big enough to where it's a serious issue behind it going on, and that might be higher than what you want to tackle. So those are 1 and 2. Number 3, try to filter it down to properties or cities that only have properties under 125,000 as best you can. Columbus is one of them. Milwaukee is one of them. So just, you know, use that Zillow filter if you're going to use Zillow for a quick solution to look at price points. And that could help you determine at a high level, is this city worth it to visit, and maybe talk to wholesalers, join some groups to explore further. Because the price point of 125 and down will help you to determine, oh, if there's enough scale of this here, then that means the off-market price points are much lower then.
Okay, way cool. Well, hey, I was just one more question that just popped in. And then I'll just share this with you, Ivan, when we go offline in just a couple of minutes. But appreciate everyone showing on up and coming on the webinar today. We're up on time, so got to bring this one to closure. But thank you for attending. If anyone does want to receive a copy of the slides, you can always reach out to me. Here's my contact information, phone number, and email address here at Advanta IRA. And then, of course, happy to get you in touch with Ivan if you wish to speak with him about what he might be doing in the future, if it's something that's of interest to you. So with that really being said, let's just put this webinar in the can. We will have it posted on the website and the YouTube channel in about 24 hours. And we look forward to seeing, or I shouldn't say see, but gathering with everyone again next on Thursday when we have our next webinar here at Advanta IRA. So with that being said, I'm signing off for this one, and everyone have a great and productive day.
Thanks, y'all.